Now what we'll do is just talk about some additional factors. So tax effects are important. Why? Why are tax effects important, Umar? What? Okay, I'm just looking for a really basic answer. Why? Yeah, exactly. There's just a very simple point that tax is a real cash flow. So what really matters is how much money you are making after taxes. Okay, that's the core point. That's the main point. Then what are the secondary points? That you have to consider taxes, because based on and to figure out taxes you need to figure out depreciation and so on. But the bottom line is that if you do an analysis that says, okay, this project is great, but oh, by the way, I just made an assumption that there are no taxes. Okay, what would be wrong with that? Okay, that's a blatantly incorrect assumption, and you are probably then overstating cash flows. So a project that really should not be accepted might be accepted because you have ignored cash flows. Okay. Another point here is faster depreciation results in higher depreciation expense in earlier years. So what a lot of countries allow you to do, and this is legal, where for tax purposes you can depreciate more initially versus say straight line depreciation. What will that do? If you can, in the early years of your business, if you can depreciate your equipment on an accelerated basis, that means that if you are depreciating an equipment worth 100, if you can depreciate on an accelerated basis, in the initial 2-3 years you can depreciate off most of the value. So Shahama, what's the benefit of that? My question is that if you are allowed by the tax authority of your country to do accelerated depreciation. Do you remember what that is from accounting? What's accelerated depreciation?
Depreciate faster.
Yeah, you can depreciate faster. What's the benefit of that? Yeah, in the earlier years it will save on taxes, but then will you have to pay the taxes later?
Because it doesn't.
Yeah, so let me just give you just understand this. Generally, in companies, finance and accounting go hand in hand. You don't have a separate. Okay, so let me just set the context here. What this means. Okay, let's say you get a machine for 100 million, so a very expensive piece of equipment. Now, the point is this, that the financial accounting rules for depreciation are not necessarily the same as the tax rules. Okay, what does that mean? That means that which rules do you follow when we talk about financial accounting? You follow the accounting rules which are called International Financial Reporting Standards. Generally, according to IFRS, what companies do is straight line depreciation. Okay, so let's say you do straight line depreciation over 10 years and the salvage value is 0. So what will your depreciation be? 10, 10, 10 over your 10 years. Okay, now let's say the country in which you operate, the tax rules allow you to do accelerated depreciation. Now I'll just make up, there can be many different kinds of accelerated depreciation, but one might be that in the first year you can depreciate 50, in the second year you can depreciate 30, okay, and then the remaining 20 is depreciated 5, 5, 5 and 5. Okay, these are two different depreciation mechanisms. In both cases, over 10 years you depreciate 100. But what's the advantage of this tax method? The advantage is that your depreciation expense is higher, which means that your earnings before tax is lower, which means that your tax expense is lower in the initial years. But what happens later, like in these years? Later you have to pay more taxes. But most companies are more worried about what they need to do now or what they need to do after 4 years. Most companies are more worried about what they'll do now, so they will take a dollar saved now over a dollar saved later. Does that also make sense in terms of time value of money? It also makes sense in terms of time value of money. Okay, so just put that in your head and now we'll go through the rest of the stuff. Okay, the straight line method of depreciation everybody knows, I hope. Okay, does anybody not know what the straight line method of depreciation is? If not, this is what we just talked about. Equal depreciation amount over the life of the asset. Accelerated depreciation method, this one example of accelerated depreciation I just gave you, this is where you depreciate more initially and less later. Is there just one accelerated depreciation method, or can there be several methods? There can be several methods. And do you understand the fact that a tax authority of a country can allow accelerated depreciation even though, let's say, a different method is used by the financial standards? Are you understanding this point? So this is a fundamental point in business and in finance, that you can maintain legally a separate book for your accounting purposes and a separate book for tax purposes. Okay, why? Because some rules on the financial reporting side are different from the rules on the tax reporting side. Okay, and one example of a difference in rule is the tax authority might say that you can do accelerated depreciation, whereas the financial rule side might be doing straight line. That's one example. Another thing, just to illustrate that there is nothing wrong with having different rules, on the financial reporting side, how do you calculate net income? You calculate it based on the accrual basis. If you have 100 million revenue in a given year, half of which is based on receivables, did you actually get that money? No. But your net income is still based on 100 million revenue. Your earnings before tax is still based on the 100 million revenue. So your taxes will be calculated based on 100 million revenue. But the tax authority might say that you pay taxes only based on actual cash received. Do you understand that distinction? Okay, so the bottom line, whether or not you fully understood that, the core point here is that the rules of the financial reporting side and the rules on the tax side are not necessarily the same. Okay, and there is nothing illegal about that as long as you are properly following both rules. So when people say we have two sets of books, one for taxes, one for financial reporting, that in of itself is not bad. What is actually wrong? If the company is actually misstating numbers and not showing profits in order to not pay taxes, that is incorrect. But as long as you are following the rules of the country you're in, that's fine. Okay. The accelerated depreciation method that we'll talk about is called MAC-RS, which stands for Modified Accelerated Cost Recovery System. Okay, this is a US based terminology, but the concept that you will learn here, the reason we are doing it in this class, is that the name might be slightly different in Pakistan and in other countries, but in most countries system such as this does exist. In terms of basic terminology, I'm just building up and then we'll get into the example. What does depreciable basis of an asset mean? Exactly. This is the amount that you will be depreciating. So for example, if you buy a machine for 20,000 and then 5,000 is installation and setup, then 25,000 is your depreciable basis. And depreciable life is the life over which you are depreciating. Okay, now let me just understand this, help you understand this MAC-RS schedule, and these numbers might be slightly different in Pakistan, but the concept is what's important here. The way this process works is, every asset that you are going to depreciate, the first thing you do with that asset is identify what the class of the investment is or what bucket it must go into. I'll give you an example. Computers generally have a relatively long life or a relatively short life. So computers will have a depreciable life of 3 years. Okay, you might have some equipment that lasts on average 5 to 6 years. Okay, so that equipment will be put in this 5-year class. Okay, so there is this big fat tax manual that will tell you this kind of asset needs to be put in the 3-year bucket, and in that category, laptop computers, desktop computers, etc., the tax rule will say, okay, this sort of equipment you should depreciate over 3 years. then this sort of equipment you should depreciate over 5 years. Do you remember the example that we did in the previous class, or 2 classes ago? We had depreciation expenses for equipment, and in the first month in the first year we used a percentage of 20% depreciation, in the second we used 32% and so on. Okay, I don't know if you remember that or not, but that is where a piece of equipment is put in the 5-year class. Okay, so then the accounting or the tax manual will tell us that for equipment in the 5-year class, in the first year you depreciate 20%, then 32%, 19, 12, 11 and 6. So notice that from the highest depreciation is in the second year, and then it comes down after that. Why do you think that is? So there are 2 points here that seem a little awkward on first glance. One is, if an item is put in the 5-year class, it's being depreciated over how many years? 6 years. So in general we have n plus 1. So if an item is in an n-year class, it's being depreciated over n plus 1 years. That's one question that should be popping up in your heads. And what's the other question that should be popping up? So why is the second year more than the first? So can any bright kid in here come up with an answer to either of those two? Don't tell me there are no bright kids here.
That doesn't mean.
That's a bright comment. No thoughts on that. Wild guesses. Okay, you get a check mark for trying, but you need a. Huh? Okay, look. So Okay, anyway, at least you are thinking. That's the. Okay, now. Okay, so in the first year that you buy the machine, is it necessary that you buy it on day 1? No, it could be bought after a month, after 2 months, after 6 months. It could be bought in November. The machine could be bought in December. Okay, so it could be bought anywhere over the first year. Since you are not sure when it will be bought, is it fair to then just say, okay, if you are to take a wild guess, you guess somewhere in the middle of the year? It could be bought anywhere in the year. So rather than make life complicated and try and figure out exactly where, on what day the machine was set up and depreciate according to that, we make just a very rough assumption that in the first year we will only depreciate effectively for half the year. Yeah, so the point is that we are just assuming usage. It's a very rough assumption, but we are just assuming half year usage. So for a 3-year asset, we are essentially saying that we are using it over 3.5 years. And in the first, this is just the way the tax schedule is set up. So 3-year really means 3.5 years. 5 years really means the machine is over 5.5 years. Yeah, 0.5 being 6 months. Okay, and the 33% corresponds to the 0.5 or half a year. Okay, so we are essentially saying that the first 33% is being depreciated over the first half year, and then the remaining amount, 45, 15 and 7, is being depreciated over the remaining 3 years here. These numbers are over the remaining 5 years. Okay, that was just to help you understand where these numbers come from, but bottom line, when you actually do this on a exam, or if you for some strange reason become a tax accountant and need to worry about all this stuff, okay, then what will you do? You will have this big fat tax manual that will tell you this asset is in the 7-year class. That means you need to depreciate it over 7.5 years. In the first half year you will depreciate 14, then 25, 17 and so on. Okay, so this is just a schedule. Most things in the tax manual are rules, schedules, tables that you need to understand, know where to apply, and then apply. Okay, so this will be given to you. You will not be expected to memorize this. No, you're not doing what you wish. You are being given this schedule. Yeah. Yeah. And there's also like some assets might be in the, like land and building will be in the 29-year bucket. So when you are, let's say you are a tax accountant or so what will you do when you are depreciating an asset? What's the first thing that you'll have to figure out? Which bucket does it belong in? Once you figured out the bucket, then what do? Let's say you figured out it's in the 10-year bucket. Yeah, then you will depreciate over. Yeah, then you follow the schedule. In the first year you will depreciate 10%, then 18%, and so on. So this is not meant to be any rocket science by any stretch. If you think this is difficult, then you've not understood something. Okay, so a comment is, can we do accelerated depreciation initially and then straight line? There are many different schedules. This is what is used mostly in the world. Alright, okay, now next point. If you didn't quite get that, you can see me after class. Okay guys, so now next, so we are just going over several items. The next item is adjusting for inflation. Okay, this is a reasonably involved topic, but at our current level we'll just go through the main points. So inflation is a fact of life. It's all around us. In some countries there is more inflation than in other countries. So how do you deal with inflation? The simplistic thought process is the following, that when you project your cash flows, you just should project nominal cash flows. What does that mean? Yeah, so that means you factor in inflation. Now, is that what you normally do? Actually, it is what you normally do. If you think about it, somebody who knows nothing about finance might still say to you, okay, go buy that TV now because next year the same TV will be, let's say that currently you can buy it for 60,000. They might say that next year, maybe TV is a bad example, but some item, buy it now because next year it will be worth not 50,000 but 60,000. Does that sound familiar? Yeah, what very often, so the point is we are so used to inflation that we just think in terms of inflation. We don't think that, okay, the real price of this, we don't think about the fact that the number of goods and services is the same. So in real terms nothing has changed. We are actually tuned to think in terms of the price of the item. And given that all our lives we've seen inflation, we just automatically think of prices with inflation built in. Okay, so the point is, in all your cash flows, the way we did in our example earlier, did we build in inflation into our future revenue expectation? Yeah. We did. We said the inflation is 2%, and the price, we said that the number of items we are selling will remain 20,000. So in real terms, was there any increase in sales? But in terms of the dollars earned, was there an increase? Yes. Purely because of inflation. So in our analysis, we actually looked at the prices based on inflation in the prices. Okay, so that's called nominal numbers. So in real terms, what would the sales price be over the next 5 years in my earlier example? In real terms, the price would have remained 3. But in nominal terms, we factor in the 2% inflation. So when we say nominal cash flows, what do we mean? Yeah, that means that we have inflation built into the numbers. Okay. Now, when you have inflation built into, so that means your cash flow numbers are numbers with inflation there. So the discount rate that you use then should also have inflation built into it. Agreed or not? So the core point is, the way you deal with inflation in your analysis is that if your cash flow is numbers with inflation in there, then your discount rate should also have inflation in it. Okay, now let's move on. So in terms of the discount rate having inflation, a very basic side point, and then I'll come back to putting things together. When we say that in Pakistan the risk-free rate is about 12 or 13%, let's just say use 13% for now. If the rate is 13%, does this include inflation or not?
Yes.
It includes inflation. If this was a return without inflation, then the whole world will be investing in Pakistan right now. And the last time I checked, the world is not investing in Pakistan. Okay, wish the world was, but it's not. All right. So just as a side remark, actually let me just, so the theory is this, that in general the risk-free rate, so the risk-free rate will be equal to, approximately equal to the inflation amount plus the real return. Okay, so here is a not too bad scenario. If the risk-free rate is 13% and the inflation is 10% and the real return is 3%, this is not bad. Okay, so do you understand that when we are discounting using 13%, for example, that 13% includes inflation. Okay, in general, when you in let's say in the Eurozone, if the discount rate being used in Germany is, I don't know the exact number, but it's going to be some small number like 3 or 4%. Okay, so in a developed country such as Germany, you might have a discount rate, a risk-free rate of say 4%, and so the rate is 4%. Inflation is going to be something like say 2%. That means the real return is 2%. These are approximations. Okay, now coming back to Pakistan, why is nobody investing here? Because the inflation unfortunately is actually more than the risk-free rate. So that means that the real return is negative. And what's the interpretation of that? The interpretation is that even if you invest in a government T-bill, government risk-free rate giving you 12 or 13%, okay, what's the issue? You invest 100 in a government security, guaranteed you will have 112 or 113 at the end of the year. But the buying power of that 112 is less than the buying power of that 100 today. So in real terms you lose out. And what about from the perspective of a foreigner? A foreigner who's not buying in here, but what's the worry for a foreigner? That he might put money in Pakistan. Okay, even if he invests at the risk-free rate, at the end of the year, when he, let's say he invests 100, at the end of the year, how many rupees will he have? Let's say he has 112 based on a 12% risk-free rate. So does he jump with joy that he has 112 rupees? Maybe for a moment he does, but when he converts that back into euro, because of the inflation, the exchange rate would have moved negatively. So when he converts back into euros at a much worse exchange rate, he will actually lose money. Okay, now this is actually a separate area of finance, but if you want to talk about that, we can do it separately. The core point here right now is that whenever you are told that the rate is this, is your default assumption that rate is the default assumption that the rate is nominal or real? Yeah, again the default assumption, like if you are told the rate in Pakistan is 12% or the rate in Germany is 4%, unless you are told otherwise, the assumption is that you are using a nominal rate. How can you, and as a side remark, what's the exact relationship between nominal rates and real rates? It's this. It's 1 plus R is equal to 1 plus R. This, what is this R in? The nominal rate. What's this? Real rate into 1 plus inflation. Have you seen this before? Okay, you should have. Alright, somewhere. So this is a very basic relationship. Have you seen this relationship, that the nominal rate is approximately equal to the real rate plus inflation? Okay. Anybody here bright enough to figure out why we can say both this and this? Cancel the ones. Okay, you're on the right track. Okay, I'll just give you a simple example. I don't know how many people have actually thought about this. This thing in red is called a linear approximation of what we have over here. So let me show you very simply. If I were to actually multiply this out, I hope you remember your class 9 multiplication of, in algebra. So what is 1 plus Rn would be equal to 1 plus okay, so it would be 1 plus, and then you have I plus the real rate plus the interest rate, the inflation into. Okay, now in most countries inflation is relatively low, So inflation might be 2%, which is 0.02. The real return is also relatively small. It might be, say, 1%. So when you multiply these two numbers, you get something which is very small. Okay, so as long as numbers are small, approximately this is 0. So what are you left with? Then you are left with the nominal. You cancel the ones, as was pointed out. The nominal rate is then approximately, this becomes an approximation now because we cancelled this out. So the real rate is approximately inflation plus the real rate. So this then becomes a linear approximation of this formula. So it's just basic stuff that you learnt in class 9, and at the time you did not figure out how this will ever be useful. Now you know. No, very rarely. But it could be. I mean, there's nothing in it could be. Actually, most developed countries try to target inflation at around 2%. During times of good economic growth, you could have a real return that's more than 2%. So there is nothing, no economic or financial rule that says it can't be. But okay. Ideally though, what should happen? Ideally though, your risk-free rate should be greater than inflation. And if it is not, then what do we say? We say that our real return is negative. That's a separate point. So the question is, the risk-free rate is always greater than inflation. Shouldn't that always happen? It should, ideally. But what's the risk-free rate in Pakistan? Yeah, so the risk-free rate is approximately 12%. That means you put 100 rupees in a T-bill today. How much will you have at the end of the year? 112. So 100 is, what's inflation in Pakistan? 20%. Well, depends on who you believe. Okay, but based on my experience, it's at least 15%. So what's the real return in Pakistan? Minus 3%. That means even if I put money in T-bills, at the end of the year, I might have more rupees, but my buying power is less. So since my buying power is less, I have actually lost money. Okay, so that is so as homework, do this exercise now. Let's say 12% is annualized rate. So what's the monthly return? 1%. Okay, so now do a calculation where you have 100 and you get a 1% return per month. How much will you have at the end of the month? Okay, this is after class. I understand your question, and there's a nice answer to it, but it will take some time. So after class. Okay. So now we've actually not done too much so far. Can you quickly summarize, quickly summarize what we've talked about? Okay, so very quickly, we've talked about depreciation schedules. We've talked about the importance of taxes. And the third thing we talked about is how do we deal with inflation? We take nominal numbers for cash flows and we discount at a nominal rate. Okay, now the next topic is project risk analysis. So imagine now again that you are running a business unit at a company and you are deciding to do a project. What we've done up till now is effectively said that, look, here are the cash flows, here is the WACC at which we will discount, and we get a NPV. Okay. What else do you think a good professional should do? Are you sure that the cash flow that you projected is what you will get? No. So any good professional will also do some sort of a risk analysis. Maybe you will have different scenarios, a good case, bad case, average case. Because the cash flows that you projected, maybe those are projections based on the most likely scenario. But how often does the likely scenario not happen? Quite often, right? If you try to project what is going to happen, maybe that is the expected value, but maybe things will be better than that. But more often than not, things end up being worse than that. So how do you deal with that? You can do a risk analysis. And there are several types of risk, there are several types of analysis. Let's just talk about the different kinds of project risk. One is standalone risk. Standalone risk is, so there's standalone risk, corporate risk and market risk. Let's talk about these. So what do you think we mean by standalone risk? Yeah. So this is, if you just look at the project in of itself. Okay, I'll give you a simple example which again will help you relate to this. Let's say that you are running Indus Motors and you are planning to start a new business called the spare parts business. Alright, so that's a separate business unit. Now that business will have its cash flows and it will have a cost of capital and so on. Now if you just look at that business, okay, will the cash flows be up and down? It will be. If you simply look at the variability of the cash flows of that business, then the variability of that, how do we capture variability using we capture variability using standard deviation. So if the variability of the cash flows is high, that means in some years cash flow is high, some years cash flow is low. So if the variability is like that, then the standard deviation is high and the standalone risk is high. Okay, so when we talk about standalone risk, it is basically a measure of the variability of cash flows of just that project. Okay. What this is ignoring is a diversification benefit, and we've talked about this briefly earlier. Now, the reason I picked this example is, when does the spare parts business do well? It generally does well when the economy is not doing so well and people are not buying as many new cars. Okay, so this business standalone might seem risky, but when you look at it in the context of the overall company, then maybe it's not that risky. Why? Because when the company is selling lots of new cars, then this business is down. But that's not such a big deal because you are making money by selling new cars. On the other hand, when the economy goes down, what happens to car sales? Car sales are down, but maybe your spare part sales is up. Okay, so then if you take from a corporate risk perspective, so when we talk about corporate risk, how do you think this is different from standalone risk? Yeah, so corporate risk means that you look at the risk of a project where you consider the project as part of a portfolio of projects. And what's the portfolio of projects? It's the various projects in the company. So think about it this way. The corporate risk would be the impact of that project on the risk of the overall company. Does that make sense? So again, the things that I am explaining to you here, just if you can also think about the benefit of this. The sorts of things that you are hearing, if in the right place and at the right time, you can say this to your interviewer or your boss, the chances of your promotion become much higher. Okay, so for example, when you are evaluating a project, you can say, okay, the project seems risky, but sir, what if we look at this in the context of the overall company and recognize the fact that when this project tends to do well when our other businesses are not doing so well. So isn't that a good thing? Okay, so that would be you can just hear the guy think that this kid is smart. So anyway, these points, if you can just internalize, they are good for you. Yeah, you can essentially, that's very good thinking. Maybe not negative, but it's relatively low. But in the example that I am giving, effectively the beta is coming out to be negative. But do you understand the larger point? Standalone risk was the variability of a project where you are just looking at that project standalone. Corporate risk is you are looking at the impact of that project on the overall risk of your corporation. And what is a large corporation? A large corporation is a portfolio of the different projects that it does, right? And then the third category of risk is market risk. Okay, this actually is a little more vague, but I'll take a step out of this and then come back. When you talk about the market risk of a stock in your portfolio, what is that? It's the risk to your overall portfolio of investing in a given stock. The same analogy can be applied here. Imagine you have an investor who has invested not only in your company but in various other companies. Okay, now the question is this: by doing this project, what is the impact to the portfolio of somebody who has not only shares in your company but shares in a bunch of other companies? So in other words, what's the correlation of this project with a well diversified portfolio in general? Okay, I'm not sure if that fully made sense or not. If it didn't make sense, it's not such a big deal because it's a little too abstract. As long as you understood the first 2 points. Did you understand the point of standalone risk? Okay. Did you understand the point of corporate risk? Okay. Those are the two that I really want you to understand. This one you will see in textbooks, but if you start saying this to your boss, he'll think you're crazy. So if you are speaking to a finance professor, this will make sense, but that's about it. Okay. And since it's there in textbooks, I've given it. Which is the easiest risk to measure and understand this? The easiest is standalone. And the point made here is, even though the example I gave you contrasted spare parts business with regular business, but for most businesses, generally when a given project is doing well, other projects are also doing well, and vice versa. So very often, the first level of analysis you do is standalone risk. Okay, so does that make sense? Now, if you have two different projects, we've done this briefly before in our context of risk and return, project A and project B. So both have an expected, let's say NPV of 10 million. But for project A, what do you think I'm drawing over here? So this is the NPV, and this is the distribution of different possible NPVs. If my expected NPV is 10, does that mean that I'm sure that the NPV after 5 years of this project will be 10? No, maybe it will be less than 10, maybe it will be more. So often we can draw this as a probability distribution. Versus another project that again has an expected value of 10, but the possible variability in NPV can be much more. So can you see that the standalone risk of B is higher? Okay. So focusing on standalone risk is not completely correct theoretically, but it does not necessarily lead to poor decisions. So from a practical standpoint, you can and should do this. Okay, this part I'll skip. Actually, techniques for measuring we'll do in the next class. So make sure you are up with what we've done so far. You should be doing the questions at the back, because probably on Thursday next week we will have our quiz. Okay, so then on this chapter on Thursday we'll probably have the quiz and the spreadsheet. So over this weekend you start getting ready.